My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to save you a little money here. My job is not just to explain, but to put in some sort of context so you can understand it. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. When I first heard the idea that stocks could actually go down in response to great job growth, I thought it was absurd. Who hopes for weak job growth? Who hopes for higher unemployment? The answer? People who own stocks, that's who. At least when they're worried about interest rates. And that's how you get a day like today, where the labor report showed we created way more jobs than expected in December, and then for the market roll over. Dow tumbling 697 points, S&P plunging 1.5%, NASDAQ plummeting 1.63%. Now, there are two sides to the story. Given that I was worried about a hard landing and recession just 6 months ago, when I saw strong job growth, you know what? I was grateful. But we're in a moment where my gratitude means nothing. The majority of investors were looking for slower job growth, lower long-term interest rates, and some rate cuts from the Fed. For them, the disappointment was palpable. So the stocks, they sold them hand over fist, as you can see. Now, this isn't unusual. Always remember that the bond market's a lot bigger than the stock market, and the bond market gods are more powerful. So when rates go up, stocks tend to go down, and that's what happened today. The stock market won't improve until interest rates go down. We might get some better stocks, but not a better stock market, which is why so many investors are rooting for a weaker economy. Makes the Fed look better, makes you feel better that rates aren't going to be such big competition to stocks, which they're getting to be. So what happens now? Let's take a look at our game plan for next week with an eye towards seeing something positive to find that bull market somewhere. First, on Monday, we hope to get some good news out of the wildfire situation. It's always disconcerting to hear that there could be anything good coming out of the fires. But like any natural disaster, our various governments and our insurance companies try to get things on a better footing. Usually that means an expanded economy in the areas that are hit. And I think you're going to start hearing about that thing pretty soon. I don't like profiteering off tragedy, but it's undeniable that retailers do better in this environment because people have to rebuild, meaning they need plumbing, kitchen supplies, washers, dryers, dishwashers, ovens, TVs, all the stuff of modern life. Sure, some of these retailers already went up, but they can go up further. So look for the possibilities, because when the insurance checks come in and the government starts spending some money, they're going to go toward rebuilding. How about the other side of the trade? Here I'm talking about earnings. Can great earnings triumph over a sour bond market? We're going to find out for certain, because this is a week we associate with bank earnings, and there's a lot of misconceptions about the banks. We know that when they make the wrong bets on the bond market, like 2 years ago, their stocks can take some real nasty hits. But when their bond portfolios are good, like they are today, they can withstand or even profit from higher rates. So let's not write these stocks off. Before we get to the banks, though, we need to talk about KB Homes. This is a home builder with a significant presence in California. When so many houses get burned down, you'd think that it might be good for the home builders, particularly KB Home. But there is a real mismatch here. Many of these homes are very expensive. That's not KB's niche. It makes the kind of homes where higher mortgage rates really hurt sales. Plus, the possibility of a draconian immigration policy from the Trump administration will hurt the home builders in two ways. First, they're going to have to pay higher wages, and then they're going to have fewer customers. So even though KB Homes have put up some consistently good numbers all during this great period for housing, I fear that this stock could end up on the canvas. I hope to dispel the gloom a bit when I take a trip out west to the fabled J.P. Morgan Healthcare Conference. This is where we hear from almost every drug and healthcare company, and I'm going to do my best to bring you a highlight reel of the most important presenters. Get ready to be dazzled with some really terrific stories, regardless of the economy. But remember that drug stocks are indeed still hostage to interest rates, which are a more powerful force than their pipelines or even their earnings in many cases. Tuesday, we have the producer price index along with the consumer price index on Wednesday. It needs to come in cooler if there's any hope that interest rates could reverse and the Fed can regain some of its lost credibility, stemming from cutting in a hurry when we now know there was no need to do so. I think it's possible that these numbers are going to be cooler than the labor report, but not enough to justify repeal of today's losses. Wednesday, well, here it comes, host of bank earnings, and they'll get an initial boost from higher rates in the form of offering you rate-based products like CDs that offer much lower rates than the banks can earn by sticking your money in the bond market. It's a short-term windfall, but it could make these stocks worth owning. On Wednesday, we're going to hear from JP Morgan, Goldman Sachs, Wells Fargo, and Citigroup. I think they're all going to be pretty darn good. Plus, given the environment has improved for mergers and acquisitions, as we've seen already this year, we can have some excellent forecasts. I like these stocks, and they're well off their highs with very low price earnings multiples. Could it be a real opportunity? I think so. We've been buying a bunch of them for the charitable trust because a robust economy often produces the best results for these companies, regardless of the bond market or the Fed. We have fewer credit problems. Thursday, we have more of the same. This time, Bank of America, U.S. Bancorp, Morgan Stanley, and PNC Financial. I actually expect all of these to be good, too. But the best one, the most admirable, likely will be PNC. You know, PNC has become kind of a cult bank stock. The biggest health insurer, United Health Group, reports too. Now, we know this company has been in the news, sadly, after one of its highest-level executives was murdered. This group's had strong earnings of late, including, terrific. They just got some good news from Medicare, too, this very evening. So they're no longer dealing with a post-COVID hangover. They're getting better return from the government. And you know what? I suspect UNH is going to have an excellent quarter. So what can I say? These stocks probably going to work. After the close, we get results from one of my favorite companies, J.B. Hunt. It's the giant trucker. I see this company as more of a barometer business because it does such a tremendous job of breaking down the strong and weak parts of the economy line by line by line. These days, the transports everyone wants, though, are the airlines. Just look at the positive reaction to Delta's numbers this morning. I think we need to keep in mind that when you get really strong earnings like the ones from Delta, they can indeed transcend the market's negative gravitational pull. Stock looked good today. Finished up 9%. Finally, on Friday, I'm watching out for SLB. That's the old Schlumberger. They don't call it that anymore. As we've seen a few weeks of rising oil prices, I know that's not enough to turn around SLB's fortunes. It's been down in the dumps for a year and 4 months. A few weeks of good oil news won't change that. But I think that the company might give us a more positive forecast, given that there's certainly more drilling optimism around, even as SLB is a very international company. Bottom line, if you're a bull, or at least trying to make sense of this market, well, you know, a market that goes down on seemingly good news, all I can say is that the stock market that gets surprised may seem like it's reacting inappropriately until you see its master, the bond market. Explain everything by the direction of interest rates. For now, that's the key determinant of the entire stock market, even as there are pockets of positivity that can escape the bond market's tyranny. Mark in Iowa. Mark.
Hi, Jim. Well, I'll tell you, with the way the markets are these days, I'm sure glad I'm an investing club member. Thanks for all that you guys do.
Thank you. And, you know, I feel for any of the losses that come about, and I do make some mistakes. I own the mistakes, and most importantly, I do the best I can. How can I help you?
Well, I'm calling today about a utility stock that sold a minority stake in some of its transmission lines businesses. It's in a couple of states they sold that. It's valued at $2.82 billion, and it's going to go a long ways towards offsetting about $5.5 billion in equity financing until 2029. As an investor, how should we look at this move by AEP?
Okay, well, I think AEP, you look at that, that's a consistent way to be able to judge your business. This fellow, Bill Furman, we had him on. I think he's very, very smart. I will say this, though. It only yields 4%. It is indeed hostage to the bond market. I think it has more downside at 16 times earnings. Let's go to Manal in Georgia. Manal.
Booyah, Jim.
Booyah.
Thank you so much for guidance with effective investing strategies, which are in turn profitable as of now.
You are very, very kind.
Oh, thank you so much. It is in the news that Nucor is going to build a new production facility of $200 million in Utah, which will generate about 200 full-time jobs. And it is about to complete similar production facilities in several other places. So Nucor stock had gone as high as around $160, and now it has fallen about $118.
Yeah, well, it did go up to 200. Now, I'll tell you, man, what happened here is very interesting. They bought back a ton of stock much higher. That was ill-advised. Then the Mexican, let's say China, used what's known as transshipments, dumping steel through Mexico into our country, depressing our prices, and that's what's hurt Nucor. And I've got to tell you, that may not be done until President-elect Trump comes in and says, no more Chinese steel from anywhere. And then Nucor stock's going to take off like a rocket. Right now, interest rates are what's controlling the stock market, and we don't want their control because rates are going higher. Our job is to find some inflation-proof pockets of positivity to escape the bond market's tyranny, and it's not easy, although we will have some charts later on that gives you a nice place to look. On Mad Money tonight, I'm circling back to those charts to see whether we can have a tech rebound. Now, after this week's market action, I'm also going to break down the thesis, see how much of it still stands. Then, ahead of the NFL playoffs, could DraftKings be a touchdown buy at these levels? Anytime. I'm kicking off the weekend by giving you my anytime take. Plus, Constellation Brands sank 17% on its earnings miss. I took this very personally because my charitable trusts own it. Let's speak to the CEO to see if there's any turnaround, let's say, on tap. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.